Let's now look at the last but the most important part of financial investments, essentially the asset classes. So we defined the persona as John Neff, age 25, a production engineer working for an automotive company in Dearborn. By now, we know that John has his mindset aligned the right way. He has, in fact, gone a step further to do a very good financial planning. And now the question is, how will he invest his savings? What you see here is a table which gives the major asset classes that are available to any of us all over the world to invest in. That is the first column. And these asset classes are equity, which is nothing but stocks or shares of a company; debt, which is nothing but bank deposits, fixed time period deposits, bonds, etc. Third would be real estate, which is self-explanatory, easy to understand as land, building, commercial property, and so on. And the fourth is commodities, which we will talk about a little bit. Commodities like gold, silver, and even other commodities like pork bellies and so on. Followed by cash, which is again self-explanatory. And finally, alternative investments like art, diamonds, crypto, and so on, where it's a little tricky, and we'll talk about that. So these are the 6 asset classes. There could be esoteric ones other than these 6, but 99% of investment goes into one of these 6 asset classes, and we need to understand each one of them. Why are they distinct? For one or two simple reasons. Reason number one, the risk reward associated with each one of them is very different. That means if the reward is high, the risk is also very high. If the reward is moderate, risk is moderate. And if the reward is low, the risk is low. That is one distinction between each of the asset classes. The second one is liquidity. Some of these are highly liquid. You invest in them and then you have an emergency tomorrow. Within a matter of 1, 2, or 3 days, you get back what you have invested. But there are others like land. Could have appreciated substantially, but when you're in a crunch, when push comes to a shove and you want the money, it's not going to be easy. It may take 3 months, 6 months, 8 months, depending on the market situation. And then there are highly liquid ones like cash. You withdraw it and it's instantly yours. So that is the second distinction. By the side of these asset classes, you see what I call the vehicles which allow you to invest in one of them. So when someone says that I am buying a mutual fund, it's important to know that mutual fund is not equity. Mutual fund is a vehicle on which you can place equity, you can place debt, and sometimes you can even place commodity. In other words, the way you invest equity can be direct in terms of going to a brokerage account, opening a brokerage account with one of the brokerage companies and directly buying a share or a stock of IBM or Apple or Facebook. Or you could buy a mutual fund which has underneath it the shares of Facebook, Google, IBM, and all of that put together. So remember the distinction. Asset classes are only these 6. The vehicles that allow you to invest in any or all of them are the ones which are listed by its side. So if you take equity, you can invest directly, in which case there's no vehicle. You have directly opened a brokerage account and bought it. Or you could invest it through mutual fund. Or you could invest it through exchange traded fund. Or you could invest it through a portfolio management system where somebody else takes your money and puts it in stocks and shares. And last, in derivatives, and derivatives cuts across all these asset classes. What we need to do now is to understand these vehicles better so that you have a good understanding of, if you decide on a particular asset class, which vehicle would you choose and why would you choose it for investing your savings? This is number one. The second thing to understand is if I have these 6 asset classes, do I invest everything in one or in 2 or 3 or in all of those 6? And that is called asset allocation, and we will discuss that more. That is a function of how much risk you are willing to take. Just a word about risk. Often risk, when you are sitting and listening to a video like this or discussing financial matters, risk appears very abstract. What is risk? You say, okay, I may lose a little bit. That's not so. Let's take some of those breathtaking moments. 1999, 2000, when there was a dot-com bubble bust. 2007 and 8, when there was a subprime crisis. 2021, 22, when there was a pandemic. Those are the times when you understand what risk means. So here is a situation. You have $100,000, you've been saving wisely, and you put all of it in stocks. And you put 100,000, and today the value of it is 150,000. You feel thrilled because you've got a 50% appreciation over a period of 3 or 4 years. And God forbid, let's say there is a calamity or if there is a catastrophe which hits the world and the stock market plummets. All of a sudden, that $150,000 of yours will be valued at $75,000. In a matter of days, if not weeks, even before you quickly try to pull out your stocks and convert it into cash, your value could have plummeted substantially, come to half. Now, what does that mean? That means all those hard-earned money and the time you have spent 5 years creating that saving and investing is now valued well below what you have saved, which is $100,000. It's less than the value by 25,000. And therefore, your climb up the stairs starts all over again. It's like a treadmill effect. You have actually slid back. Are you willing to take that risk? Will define how much risk you are willing to take. If you say yes, then, and you say that I will still survive and nothing will happen to me, then you say I will allocate a substantial part of it into stock. But if your answer is no, I cannot take that shock, it'll be too much for me, then you say, how do you allocate it across other things? That whole process is called asset allocation, and we will talk more about it. But for now, let's go into each of these asset classes, especially equity, followed by debt, and then real estate, and finally, cash, to figure out what are all the vehicles that exist. In the case of real estate, it's fairly simple. You buy a piece of land and it appreciates or depreciates. That's an asset which you own. You buy a house which you don't occupy but which you rent out. That's an asset, investable asset. The third, you buy a commercial property and again let it out on lease to get lease rentals. That's an investment. The important distinction to know with real estate is that the property you occupy as your home is not an investment. Because if you sell that and say, oh, it is worth $1 million and I am rich by $1 million, the question will be, if you sell it, where will you live? You'll have to buy another house. And if that other house is $1.2 million, you no longer can call this as an investment with a return, and therefore a home is a home. So when you look at real estate, you value all the real estate which you have, which you have bought, except your home, which is your dwelling in which you live.
Thank you for watching. If you want to dive deeper into this topic and stay updated on our latest content, be sure to subscribe now. And if you found this video helpful, don't hesitate to share it with someone you know. Let's spread the knowledge and the fun together.